Hey, greetings. Thanks for joining us on this Wednesday afternoon, May 15th. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our macro advisor edge manager, Craig Shapiro. Talk all things macro to micro. We do this every day with our clients, Club and Edge, but we make this available publicly for those who are interested in our respective takes. I'm a little bit more focused on market direction, sector rotation, stock picking, and Craig is absolutely all things macro and interpreting lots of recent data, as well as running his own book. Lots of models that he's going to discuss today. And basically, we open it up to Q&A. So if you'd like to ask some questions across any asset class, feel free. And Craig, I'm going to send it over to you and basically say, catch us up, because obviously we had the all-important CPI and PPI yesterday. And oh my goodness, we had Yellen, we had Powell. We're over the hump. And we're also over all-time highs. So catch us up on the macro so then we can dig into the micro, please.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah, last week was a quiet week, and this week was going to be a little bit more active with PPIs and Powell yesterday, and CPI and retail sales today, and more data. And then we get through the data, and by the end of the day, it's quiet again. So maybe it's going to just keep being quiet. I don't know, but it is an expiry week. So that certainly has had some impact on kind of the trading dynamics in place this week. And we also had with Powell yesterday and the CPI today, lots and lots of zero data expiry hedging that's going on. It seems like for all these big events, folks are just hedging a day in advance. And so we wind up getting into situations where vol for the event is incredibly elevated. And then no matter what happens, the event comes and goes, and vol gets sold down for the day. And so I almost feel like there was probably no data point that could have come out today on CPI that would have meant anything that could have took vol back up again from the level it closed at yesterday on the intraday vol basis. And so because nothing that came out today really was likely to change what the Fed is likely to do. And so maybe just stepping back, look, we had another pretty firm CPI reading. It wasn't as bad as it could have been, but it certainly wasn't good. At the 0.3% on core and 3.6% year over year core. Super core, which is core services X housing, something I noted is at a 1-year high. 4.9% up year on year. It's basically made new highs 5 or 6 months in a row, and the 3-month annualized on Supercore is above 6%. So 50% of the CPI components are in core services X housing, and that's running close to 5% annualized. So I don't see any legitimate case to be made for inflation returning to 2% anytime soon. And yet the Fed seems to want to continue to run with this idea that its policy outlook is asymmetric, in which case what I mean by that is still the bar to cut rates is lower than the bar to hike rates. They don't feel like they have to reduce accommodation. They don't need to tighten further. They'll just wait. They'll just wait longer. And they'll keep, if we're not getting the data, they'll just keep rates higher for longer and longer and longer. And what the market, in my view, continues to do is they continue to call BS on that. And so as long as there's not dual-sided risk to the Fed's next policy move, volatility will continue to get sold and risk assets can continue to levitate. And I think that's what we saw again today. And after Powell yesterday kind of delivered the same message from what he had given at the May meeting, which is inflation is not coming in as we would have expected. We're disappointed, but we don't feel like we need to raise rates in order to address it. So kind of in this bizarre, and now look, maybe he was waiting for today's data and there really hasn't been much in the way of there was a ton of Fed speak today. Tomorrow there's 4 Fed speakers, and the next week there's another dozen Fed speakers. So we'll see if the language, does start to move, that this data is a concern. But look, as long as there's asymmetric risk that the next policy move is going to be a cut versus a hike, the market's going to continue to loosen financial conditions. Animal spirits will be engaged. And we saw that again today. Vol gets sold, stocks to the highs, Bitcoin up 8%, gold up 120 basis points. Even bonds rallied, which is, I can't even really explain why the long end is rallying at this point. But, it was definitely a dollar got sold. It was clearly a euphoric day, but it also is an expiry week. And we do have to, kind of keep that in mind. So, but it's hard to be negative on risk assets when risk assets are breaking out to highs. So have to kind of keep that in mind.
Well, we definitely have filled the hourly gaps, which was something in part of my kind of reflexive bounce thesis the past few weeks, late April. So we had a 445.45 hourly gap fill. So that was really focused and high conviction on that. We filled that yesterday, pre-CPI. And then basically I had a client say, so what's your conviction now? And I said, the most I can give you is my prior SPX price target that I made in January of 53.40. And then remember, I pulled that back very strongly on March 1st when gold started shooting higher. So now that we have basically gone through the pullback in the markets in April for 3 weeks, then had that reflexive bounce to gap fill 5,200 and 445 Qs, we're headed to that 53.40. It's so close. So now what we do there matters. I think that's actually, and it had been my call that was the top for the year. When I said it in January before that FOMC meeting, now we're almost there. We're like 40 points away. So let's go tag it, get it over with, and then let's see what happens. But it's not going to happen be, a change of sentiment or option flow until we get through NVIDIA earnings on the 22nd. So I'm definitely focused on that as a date of potential. Okay, we've got all of our information out of the way now. Now let's see what we get for May, June, and July. But I'm still not a huge bull, but I'm definitely a bull into 53.40. What's your sentiment through the summer?
Yeah, so I'm in the camp that the long and variable lags of monetary policy, which have been offset this cycle because of the government borrowings and, being as high as they are. And so higher rates have been more stimulative because households and corporations locked in low cost borrowings during COVID. So the long and variable lags of raising rates have taken longer, but I think we are at the point now where the data on the growth side is starting to stall out. And so I think we're kind of there. And so I would expect that it's not that we're going to have an imminent recession. It's more that we're going to have, more of those impacts of slowing growth, kind of in the economy and that be in the market. And so my thought is that it's stagflation with quotes because it's really slowing growth with sticky inflation. So I don't know if that's stagflation. I don't know what term we're going to have to use for it. I keep getting yelled at for using that term when I post it. But look, at core services inflation is running near 5% year over year. And truthfully, anybody who anybody who kind of lives in the real world knows that prices are up more than 2%, 3% year on year. So no one believes the numbers. There's a lot of gaslighting from the administration and from the Fed about what true inflation really is. But look, I think we're at a point where inflation is going to remain sticky for longer, but growth is slowing. And the Fed is not going to be able to address the growth slowdown as it normally would when inflation used to run below 2%. And so if it's your belief that the Fed is going to provide that liquidity to arrest the growth concern in a sticky inflationary environment, I think that's wrong. So where does that evince itself? I mean, in more cyclical areas of the economy, that are more rate sensitive, companies that are more operationally levered and financially levered, whether it's smaller caps or whether it's regional banks or maybe some housing related stuff or some cyclical stuff. I think those names and those sectors are not going to benefit from an environment where interest rates in the US have to stay higher for longer in order to crush demand to bring inflation back down to 2%. Now, does that mean that the entirety of the stock market is going to go down and at this point, I'm not sure because, to the earlier point, if the Fed's not going to address inflation, it doesn't feel like it needs to address inflation with any increased speed, then we may just continue to have, a bubble up in big tech and other equity names that kind of act as inflation hedges. And so, but I think that, in an economy that is slowing where the Fed is not going to be able to help is really not a constructive environment for equity earnings. And it's not really earnings growth momentum. It's not really a constructive environment for multiple expansion. So it's not really clear to me why I want to own, the entirety of equities as an asset class in that environment. So now I think it's the case that still the big cap names are better because they're cash rich and they have some mega themes associated with them with respect to AI. I think they are better positioned than some of the junk, some of the small cap, the non-profitable stuff, the unprofitable tech and the unprofitable small caps. But I don't want to be overly negative yet because I need to see that the Fed is going to introduce this dual-sided risk. So my positioning kind of remains the same. It's been long gold, basically long Bitcoin, and short small caps as a construct. I think that is an environment that I think I like over the course of the next couple of quarters. As far as other sectors are concerned, look, we're definitely seeing rotation into healthcare, into staples, and certainly into utilities have acted like a meme stock themselves because they are, AI driven. Some of the commodities like copper have been kind of AI plays as well because copper goes into the grid and the grid is short. And so, we're everything is kind of moving into what is going to be the best way to play AI. And so I can see how those rotations play out. And certainly we could take, we have and will continue to take advantage of on the long side, but overall, as an asset class from here, I'm not really seeing a ton of reason to get too constructive on risk.
So last Thursday, a week ago, actually, I had posted for clients, it's still a bullish backdrop. Bonds are back, right? That was kind of the thesis. First, it was a bullish backdrop, and I want to get your thoughts on this because even Goldman comes out and says 65% of this financial conditions backdrop is actually based on equity returns, and they've been rising. So financial conditions still support earnings, and earnings expectations keep getting ratcheted higher. So it's kind of like that closed loop. So we still see equities moving higher, earnings ratcheting higher, financial conditions is supporting earnings. The whole thing is just, feeding on itself. Then we had, of course, the dollar and yields softening, which was a big thesis that we were going to push back down, warm summer housing market call. So that has worked, also supportive of equities. The caveat was as long as oil and volatility are sideways to lower, and obviously both have been falling. But at the same time, the options backdrop was very bullish. Dealers were long gamma going into CPI yesterday. They were massively long gamma, not just a little bit. So 1 week later, after posting that for clients, they were really long gamma. So it's not a surprise that we broke above all-time highs after the CPI print. You and I also talked about this with clients, and even 2 weeks ago, that the window was opening for corporate buybacks. And so this is also supportive of stock. CTAs were buying, not as much stocks, but they were still long. They weren't selling, and they were ratcheting up a little bit of the buying, but they were especially buying bonds. So I was following that very closely. It was very, very hard, in a nutshell, to be short equities or bonds because this convexity trade especially for bond buying, was so strong. And if that triggers, which it has been for the past week, yields are absolutely falling with dollars supporting equities higher. So now I still see this 53.40 hitting this week, and then we'll see what happens into NVIDIA earnings on the 22nd. But otherwise, I haven't seen any degradation of size in breadth destruction that has been repaired in this recent bounce. I haven't seen any net selling of size in NASDAQ or NYSE. So underneath the surface, quote unquote, right now, with the option flow and the macro backdrop and literally breadth and volume and dollar and yields falling, the only thing that's really going to trigger a change is if we get a solid bounce in dollar and yields. So when or what macro trigger, in your view, is going to actually help that reversal in dollar and yields? Because that's right now what's making the weather.
Yeah. Look, I mean, if the Fed is not going to, well, let's step back. We know what Treasury is doing, right? We know Treasury is locked in. Treasury has its schedule of duration supply every week or every other week from now until forever. We don't get an update from Treasury until August, right? So July 31st or whatever it is, or August 1st. So we're kind of, we're locked in here on the Treasury side. We're not going to get any surprises from Treasury. So the only thing that can really move the liquidity needle is our central banks, and basically the Fed is the primary one. We can talk about the ECB and PBOC and DOJ in a minute, but as far as the Fed is concerned, if the Fed is not going to address how loosening of financial conditions makes their job harder to achieve 2%, then we're going to keep moving higher. And I think it's like every time Powell speaks, that becomes the outcome. And then some of the data comes in, and when it moves against him, the others come out and speak, and they're a bit more hawkish. And then we, introduce some volatility again. So look, I think where we are right now is vol's completely on the floor again. There's no hedging. Folks are buying upside again. And the data, I just don't believe supports an imminent rate cutting cycle. And I think what we're going to wind up hearing, even after today's data, even after this inflation, I mean, look, I mean, you could say, well, retail sales were weak, and so growth is decelerating, and the Fed knows that, but inflation is too high. And anybody who thinks that the Fed is going to be rapidly cutting to address growth concerns in a sticky inflationary environment, I think is incorrect. And so as we get through these periods around expiry, the probability distribution of different types of outcomes changes. And so it's hard to get the markets down in the week of expiry leading up to expiry. And we know that the CPI was in expiry week this week, which is rare. It's usually the week before. And so obviously there was a lot of hedging for this week and for today. But that's all gone by the end of the day today or sometime tomorrow. And then we are left with whatever reality we have. And I still believe the reality we have is one of, again, a slowing economy with a Fed that can't accommodate and a Treasury that's not going to accommodate. And so this is different in my view from, let's say, the October-November QRA Fed pivot, because I think there are people who believe we're just trading exactly what we did. October, November is now analogous to April, May. It's 6 months later. It's the same exact thing. Back then, Treasury pivoted dovishly, and the Fed pivoted dovishly because they were concerned about growth and they were concerned about term premiums and everything. This time, Treasury didn't pivot. They're selling more duration, and the Fed really didn't pivot either. As inflation is a much bigger problem today than it was back then. And so I don't see the continuation of this risk on rally, which basically is, what people are believing. We rallied from the middle of November through the end of the year, right? The second half of the quarter. People think we're just going to do the same exact thing in the second half of this quarter. And, I don't really see it. So what could stop the dollar declines, because we had significant DXY declines during that period too, would be the data as it comes out, just continuing to show sticky inflation, whether it's prices paid components of regional PMIs, import export data, oil turning back around and moving positive. That's something we should talk about. But and then look at what is the ECB going to do? Is the ECB going to go in June? Should there be a yield differential story if the ECB is going to be cutting and the Fed can't be cutting? Dollar can rally against the euro that way. What is the BOJ going to be doing? And then Fed speak, right? I mean, Waller's next week, I think, is a very crucial speech. He's been very much kind of the tone setter in both directions over the course of the last 6 months. He speaks tomorrow on payments. I doubt he's going to give any color on monetary policy, but then he does speak next week. And he's been very quick to talk about financial conditions being too loose and that being a problem. So we'll see. And that's I think that's the dynamic. But as we pass through Friday, the option story is normal. We don't have the same types of flows in place, and so the market could trade a bit truer. And we have a 20-year auction next week, a 10-year TIPS auction next week. So we get to that bond supply again, and then between as we move into June. There's there's big auctions. There's a big tax payment that gets made in June. So there'll be a big TGA build in the middle of June. That's liquidity draining. Markets have had trouble digesting a couple $100 billion liquidity drains, that go into the TGA over the last, several quarters. So those are the types of things I'm looking for over the course of the next month or so as we transition into this May to June OPEX cycle. That maybe looks a little bit different than the one we just had, which was a great April to May OPEX cycle.
All right, I wanted to show just a few charts. Dollar, since it matters. All right, this is on the weekly. This is Dixie with a rollover, really nice, solid rollover, bounce, and then trounce down into this trend line area. I could probably tighten that up. Point is, this was the QRA, kind of fake breakout, fast failure on a daily, and our bounce perfectly into resistance, and down we go to trend line support. So that has helped equities move into this, 53.40 price target that I've got. The yield curve, no, let's do side by side. Falling yields obviously have helped support equities as well. Here's this 10x2 side by side. We've talked about this, and then I'm going to show the combined yield curve. We did this little slinky action, and we're pushing up. This is where I think we also kind of get a level of resistance at this 110 level for the 2-year T-note futures, and 10-year, and then 2 years still working its way up. This is that fabulous kind of wedge that we keep referring to and waiting for Godot, basically, of when it's going to break higher or lower, dependent on the bond market's interpretation of a dovish Fed or a hawkish Fed, loosely, which is just kind of showing this. This is probably better on the daily. The 10 and 2-year yield curve is coming back down to this trend line. But ultimately, if it breaks this trend line, I still am adamant that we will fill this gap, which is about -0.60. So a deeper inversion. Otherwise, we're going to bounce here and move higher. So we're kind of waiting for that. Any comments on this 2 and 10 yield curve that we keep reviewing? Any reason for this to break that trend line and head lower into deeper territory?
Yeah, look, I think that you can make the argument, I think, that if you believe that the Fed is going to be higher for longer and that they're not going to address the growth concern that is developing quickly, the yield curve, that chart will break down and the curve will invert further. We'd have a much bigger flattening or a much larger inversion, because high yields in the front will stay elevated and yields in the back will move down, because folks have this still muscle memory about as the economy slows, I want to own duration. To me, I don't buy it, but it's I'm not the market. So
okay, but then there's also these lovely charts here, right? Which is convexity. Ooh, you can't see this very well. That's a little bit better. You know, these are CTA.
Yeah, I think position. Yeah, I think positioning has
Positioning,
been
thank you.
very much short bonds, and so look, we definitely can get into a situation where there is a you know, covering of those short positions and a flood into fixed income, you know, but it's got to come from somewhere. And so if the reason that we're flighting into duration is because of a concern about the economy slowing that the Fed isn't going to be addressing, well, like, why do we own equities, right? So, or why do we own small caps? Why do we own regional? Like, why do we own things that don't make money?
This dollar's falling and it makes it go up.
Yeah, no. So we have a lot of these. Look, in that environment, I'd much rather own gold, and I'd much rather own, you know, probably own Bitcoin. I don't see an earnings growth. I don't see earnings growth momentum improving in an environment where the economy is slowing and the Fed is not cannot address it. So
Okay, but aside from the earnings, because obviously you're on the other side of that argument, because they meaning earning estimates keep getting,
but that's, I mean,
but
look,
let's
we're
first
up.
like oil and inflation, you know, is expectations. This is helping that softening of yields, which I also posted last week. What is your, you know, turnaround call for oil? Because right now I still see weakness in the oil patch, and that's what I'm kind of still looking for as a point where we get some stabilization. Again, dollar and yields stop falling.
Yeah,
So
look, I mean, look at the
thinking on
economy. Look, I think oil is dealing with an economy that is a global economy that is slowing, and some strain in the geopolitical situation within OPEC and some infighting. So, you know, I think that's why oil is having it's struggling again. If the idea is that oil falling is a reflection of a weaker economy and that bonds rallying is a reflection of weaker economy, why are we flooding into stocks? Why are we flooding into the most levered, shittiest stocks? Something has to give, right? So to me,
that's a great segue for meme mania.
right, and that's what I was saying. So I look, if you want to say you want to buy cash rich corporates that are going to be fine in a slowing economy because they have pricing power, and yeah, I get that, but I don't see the broadening out of an equity rally into garbage,
No,
which is what we've been seeing over the course of the last few days and weeks. And so
somebody might have, you know, manufactured that or just really been, you know, blown out by that, but it only lasted 2 days. It may come back. Mania. We've actually tracked this over the years, right? This hedge fund factor rotation, short covering rally. It's a thing. It's actually a mechanic of going long the VIP stocks and going short junk. And right now there was a very short and sharp rally in junk, and it was not just GameStop and AMC, it was quite widespread. Now it is of course trying to calm down, but this is the backdrop that we usually see as a precursor to some volatility coming into the market. Not hours, could be in a few weeks, but usually we start to see that, you know, factor rotation, some get carried out in body bags, and then volatility starts entering in the market after the dust settles. But it is very interesting, anyway, to me, that the move index we've been also showcasing is clearly about ready to fall. And that is also supportive for softer yields and higher equities. So it is hard to fight the bullish backdrop.
And look, I ran this poll in the end of March or April as the move index was breaking down, and you know, everybody said how bullish it was going to be. Right, after the March expiry into quarter end, the move index broke down, and everybody was like, "Yeah, it's," and then all of a sudden, financial conditions loosen materially, stocks are to the moon, inflation expectations move higher, and then basically the payroll data came out for April and it was better than expected, and bond volatility ripped again. So, and I think that and the Fed speak kind of contributed to that. You had countless hawkish Fed speakers come out after the March meeting, Bowman leading the charge, basically saying, we're concerned about the loosening of financial conditions. This is a problem. And so I think that could happen again. As the MOVE index breaks down and as financial conditions are loosening, there is no ability for the Fed to bring inflation back down to target. And so we're kind of dealing with this idea that I've talked about in the past about the Fed being in the volatility dampening business in both directions. We know what the Fed does when volatility is elevated. They do what they can to walk it down. And so the question is, do people still believe, like I do, that when volatility is too low, that the Fed actually does and will introduce volatility because they are concerned that inflation expectations are running away from them? Or are we just going to throw that thesis out the window because growth is slowing enough and it doesn't matter, the inflation is in the cards, and so the Fed can kind of give up on that fight? And I think after Powell spoke at the March meeting, and after he spoke again yesterday, and after the data today, if you're sitting at the Fed, you're thinking, oh shit, here we go again. The data is, not really suggestive of us being able to cut, and yet the market is front running us by 3 steps again. Massive loosening of financial. Look, I saw today that Chicago Fed National Financial Conditions Indicator has made a new low back to what before we started tightening, and that was as of Friday. So after this week, it's going even lower, which means even looser. And yes, part of that is the stock market, but we can't sit back and just say the stock market doesn't count. The stock market absolutely counts within financial conditions, and as you can see, it's in the inflation data also. These portfolio management fees are in the inflation data. It's in there. So look, if everyone has the view that the Fed is going to be dovish because it's an election year, and that Powell can kick off a rate cutting cycle with dissent, then the market's going to go higher, and we're going to keep rallying. I'm taking the other side of that. And I think up here at these levels with vol at the absolute, basically at the lows, I think this is a good time to go, the other way. And so I'm not there. Look, I'm not short Nvidia. I'm short the most cyclical areas of the economy, and my hedge is gold. And I sprinkle a little Bitcoin on in case things get ridiculous, because they can get ridiculous. I mean, we saw yesterday with GameStop being up 100% at one point. Things get ridiculous. Bitcoin is a hedge against ridiculousness. So I'm happy to have that as a sprinkle in the portfolio. But really the trade for me is long gold and short small caps. And I feel structurally pretty good about that. As far as bonds are concerned, I'd rather be, long. I think 2-year yields maybe can move a bit lower if the Fed is forced to do a little more cutting. I don't really feel any reason to buy the back. So that's a steepener that I think is going to ultimately play out. And as far as currencies are concerned, I don't really see a case for the yen still. I still like being long dollar yen. As far as the euro is concerned, I think the euro is rallied back nicely. Europe looks like it's going to cut. European growth seems like it's actually improving. So I guess I understand if you're kind of bullish euro because you think that the central bank's going to cut and because growth's growing, then that makes sense. As far as EMFX is concerned, no real edge on that. Probably think depends, country specific stuff. So no great trades in currency land. As far as commodities broadly, I mean, oil seems like it should have a bounce here if OPEC can kind of put Humpty back together again. You have Putin and Xi meeting today into tomorrow, into the weekend, which maybe that has some implications for oil and gold. We'll have to see. Structurally, I think commodities move higher, but copper's been in a squeeze. I'm not going to chase it here. But I think there's probably some opportunities there to buy on pullbacks. So that's kind of the asset allocation lay of the land.
I'll just share a few charts because one, they're questions, and 2, kind of just to respond to some of the stuff that you have as well. So let's do this first. Whoops, let's get that out of the way. All right, that's in the way. Hold on one second. What the heck? Okay, thank you. So yeah, just Tuesday afternoon, I actually posted for clients in the, that this Bitcoin looked like it could get above 65,000 and move higher. Obviously, we needed to stick that landing and continue. Momentum is really looking better. But this is today for those who are kind of like, hey, the equity market looks good. Isn't Bitcoin a liquidity tell? That's kind of one of the questions. If it can go up, stocks can go up too. It is very, very much a play on leveraged NASDAQ. And it has totally, peaked above that key level. So just technically speaking, it looks bullish. Momentum is kind of done going down. It's rounding, but it hasn't really triggered solidly, at least a follow through that sticks the landing. But it's intonating. That's a really good kind of feel. The dollar yen, we were just kind of talking about that because I think that matters, is fascinating in that, first of all, this is the 10-year JGB government bond, 10-year yield that is, if 80, then 100. So it's basically moving up to that 1%. It is so darn close to tagging. And then we have over here the dollar yen on a 1 day, where they did the intervention on a Sunday night. Then they came back on Wednesday, the 1st of May with the FOMC and really did their intervention. Only 2 so far. I was expecting a 3rd this week because they have kind of a rule book where they do it in 3s like they did for October 2022. Anyway, it did come down by itself. And as a result, we have this very strong move higher in equities. With dollar and yield softening. So all of that right now is at a really key level because we're right back down to that kind of place where it needs to get below to support equities moving higher. So it's kind of tough. But big picture, 152 is still very, very strong support. And we're just kind of gyrating here. So Bitcoin looks very bullish. If it follows through, dollar yen is, getting the intervention treatment. Gold is over here. Gold and silver ratio, which is my absolute favorite chart. Let me just grab that real quick, is wicked bullish. So this has been my favorite chart for a few months now. And since March 1st, this is a silver gold ratio on a monthly. So, most people don't care, but that's the most bullish chart I said. March, I don't find a more bullish chart. So gold is very strong, silver and miners and metals, they're kind of, they're working off each other. So I agree with you on the gold. And then just recently on the Bitcoin for at least a trade. But as it relates to bonds, they're still working higher. And that is working with SPX until about that 53.40. We did go through kind of a rotation analysis. Hold on one second. With last Tuesday, where we finally hit that 5,200. And then I said, okay, I really need to see, very, very, very important for me, the 10-year yield get and stay below 4.2 to really embrace a bond rally. So this right now is a bond bounce, but I really needed to see it get and stay below 4.2% on the 10-year, which would further force that inversion, which would absolutely be, it would intonate in the move index rolling down and through that 93. So there's a lot to play on that. So basically, that's one of the reasons why it was very, very strong thesis the past month for XLU, and then added recently XLP and XLV because defense is still paying. So these are actually doing really well. That's basically only today did we really get a solid jump of strength in semis, and they were fabulous chases, but they have been kind of languishing, honestly, just a reflexive bounce, but not a breakout above all-time highs. So we're definitely waiting for NVIDIA to kind of set the stage on earnings and sentiment, but otherwise, I still can't see a drama unfolding for, we need a reason, we need a trigger, we need a macro trigger. And right now I'm looking for it at that 53.40, long story short.
So here's my macro trigger conspiracy theory. Let's see if I could pull this one together.
Hold on.
The last time that we had Xi and Putin basically together not maybe not exactly together, was in August of last year at the BRICS meetings. And kind of subsequent to that, what we had was a move higher in bond yields, a move higher in oil, a move higher in
That's
a move higher in
okay.
in oil, bond yields, and gold. And so, look, I don't know exactly what is going on geopolitically. I've been talking a lot about this in the room and publicly, just about, when geopolitical leaders start flying around the world, we need to take notice. And so you had G in Europe last week. Obviously, last month we had Japan come visit us in the US. We have MBS is going to Japan next week, Putin and Xi this week, and then a big BRICS meeting of finance ministers and central bankers in Moscow next week. So look, I don't know if there's,
Yeah.
but if there was a time when, from the conspiracy theorist point of view, if you thought that
That's a good one.
you thought that there was anything going on in dollar hegemony or global monetary order, what's the timing of that? Now would be a pretty good time, because the U.S. Election is coming up, and sowing some discourse and some chaos in the U.S. kind of into an election might be something that some of our enemies might want to do, and so we'll have to keep an eye on it. And that's something I'm definitely watching is how does gold trade? How does oil trade? Obviously, there's an OPEC meeting on June 1st. All these things together. You could get 1 + 1 + 1 equals 10 pretty quickly, and that could lead to your, bond yields moving higher, oil moving higher, and look, is it the stuff of conspiracy? Maybe. And so I don't put like 100% or 50% odds on it, but when you have the window of weakness, or the window of volatility expansion being open again, kind of starting next week after expiry, then these things can matter. But look, stepping back, it's about the economy stalling out. It's about inflation being sticky, and it's about the Fed not addressing it. And in the backdrop is the Treasury selling more bonds every week, the U.S. fiscal deficits being out of control, Japan having no ability to raise rates. So these are the structural things in the economy that don't move on a daily basis. And I think, yes, we can go crazy here watching them and try to understand every back and forth, machination of them. But I think as we move through the rest of this quarter, those are the themes and those are the trends that are going to play out. And, that has me more concerned about risk and equities than not, I guess I would say. And look, I think it's like a free option at this point. Nobody believes we could fall. Nobody believes the economy, in anything other than a soft landing. Everybody believes that the Fed's going to address a soft landing with imminent rate cuts. So I don't really feel like the distribution of outcomes is being priced for any type of risk. And if I'm wrong, I feel like being hedged by being long gold and having some long Bitcoin is a great portfolio hedge, because both of those assets will anticipate this liquidity infusion that it seems to me like bonds and stocks are already pricing in.
So this ties in two questions. Market feels we're back in zero rate market territory, and another, which is kind of market feels like QE instead of QT. So it's interesting that you mentioned that, because I had posted this kind of breakdown for clients a little while ago. Yeah, after FOMC and QRA, which was basically Thursday, May 2nd. I saw that US dollar and yields were going to fall, which was bullish stocks and bonds. But I grabbed something that I saw from a colleague on Twitter, and I really, really put this together, meaning market may not have realized it yesterday, but the combined efforts between Fed and Treasury actions was a form of easing. Small, but with the Bank of Japan and MOF yen intervention, liquidity is coming into the market and bidding up stocks and bonds as US dollar and 10-year falls. So remember, that was from May 2nd. But it was this colleague, which I really liked. He said 35 billion in tapering reduction a month, hopefully you can see this, equals to about 3 basis point cut a month in rates. Yellen purchasing at full size about 10 billion a month bonds makes it another 1 basis point cut a month equivalent. That is kind of some stealth easing going in. So it wasn't a big bazooka like in the bottom of March, you know, Fed bank bailout, or October 2022 or October 2023, but it is still an election year and they are absolutely supporting the market, and the market expects it. So why wouldn't we move higher? So your worry is more that economic slowdown is going to trigger some of this weakening until the market then all of a sudden says, hey, wait a minute, you know, we really don't have an earnings back trough with, you know, we're not going to be able to meet these earnings expectations, et cetera, et cetera. What are the economic weak tells that you are most closely following to test your thesis that the economy is slowing and the market just doesn't know it yet?
Yeah, I mean, the first one I would say was, you know, we saw at the beginning of the month was a pretty horrendous ISM services PMI print. First negative print we've had in 18 months, and we spend very little time typically below 50. So that was a pretty disastrous print. Obviously, there's some correlation there between services PMI and the equity market, which was not great in April. So I understand that. So, but that was kind of tell number one. Today, retail sales were pretty soft. So another indication, and clearly most of the commentary we've been getting out of the retail channel and health of the consumer has been weak. Consumer delinquencies moving higher, auto delinquencies moving higher. Seems like the housing market is largely stalled out. So, and then we had an NAHB housing survey today, you know, first drop in 6 months, pretty, you know, back into negative territory. So those are the leading indicators. We get some of those. Obviously, we had claims pop up last week in a pretty big way. We'll see if that follows through and if we get some continuing claims starting to move higher. So look, and then the city surprise index. I mean, that's, you know, for me, that's always a good tell. I'll share my screen so you can see it. Let me just pull this up here. Hold on.
By the way, that was very helpful when we actually had a push higher in non-farm payrolls to 3.9% unemployment. The move index fell. So I was watching that very closely on that day, and we actually had a really strong move lower, which helped yields to soften. So that's also supporting equities in the short term.
Right. So look, this is the city surprise index. I mean, it's
surprising.
It's surprisingly terrible, right?
Yeah.
I mean, so the question, let's go like we pull this back 5 years or so, right? I mean, obviously there's been times when, and you know, surprising expectations is not everything, but it is important. And so I think there is a view that, well, now that we're negative, the Fed's going to come in and address this. And my view is the Fed's not going to address this until it's way lower than here, because inflation is too high. And so I think we're going to continue to get these data disappointments in the overall economy that they're not catastrophic. They're just you know, evidence of deceleration, and that is the headwind for earnings growth in the more cyclical areas of the economy. So as far as this earnings growth story is concerned, market's looking for double-digit earnings growth in 24 and 25. I struggle to get it. I struggle to get there on that. If you're not going to get interest rates down, and you're not going to get labor down, and you're not really getting energy down, you're where you get, you know, I don't believe in the AI productivity story at this point yet. So I don't think that's a huge driver for margins. And then these consumer companies are coming in talking about goods deflation in a bit. So it's hard to get the top line moving.
Mm-hmm.
So, you know, I don't see the earnings growth acceleration story that I think is being priced in.
Okay. Well, the other side of that, and I was looking for the chart, but I'm having a tough time finding it. They really see forward earnings accelerating 20% in the next 4 quarters. So that's a lot. And that's based on economic growth. They meaning, you know, the keepers of earnings estimates. But the point is, there's still that support in the equities market. We would need to have some disappointment hit in order for them to reprice. So in the meantime, in the in-between time, we do have yields and dollar softening. Maybe we break into deeper inversion, but right now we haven't triggered that level yet. We definitely have NVIDIA sentiment tell. We have some Fed speak and, inflationary data, which is more than, more than sticky, reaccelerating, but not at a rate of change that is driving yields higher. And that's really the key for me in my higher yield call. It's at the end of the year. So I was actually really, really surprised when we went in most recent iteration, when we went up to 4.7 in the 10-year. I'm like, wait a minute, that's way early. I didn't expect this until the end of the year. So we did get tapped back down very strongly. Now we're tagging that 4.33. I think I can see we can actually overshoot to 4.2. My curiosity is how we're going to do at that 4.2, because once we turn around there and head higher, I think we're going to head higher in Q3, Q4. But for right now, it is a backdrop for equities and bonds and commodities, and everyone is, happy about that, except those that see the disconnect, obviously, with some of the wild, financial dominance in full view with meme mania and economic slowdown in consumer spending and the like. But we still have a backdrop where options and CTAs and the rest are bullish. So I don't see the tell yet for the flip.
Yeah,
but
look,
I'm watching 53.
I agree with that. I mean, the chart that I have up here on the screen is this core super core CPI, core services ex housing. And so look, you can see basically at 1 year highs here, 4.9% year over year. And on a monthly basis, it was 0.42 sequential month over month, which annualizes to 5%. Every reading this year has been a lot higher. And so look, the question is, it's if we're in an inflationary environment and the Fed is comfortable with this inflationary environment and is not serious about bringing inflation back down to 2%, then you want to own equities. And so when you hear Powell come out at press conferences and say things like, we don't expect to hike rates, I get why the equity market moves higher. And so what I'm saying is there at certain points, though, during these mini cycles, financial conditions loosen too much, inflation expectations rally too much, and then others have to come in on the Fed and come out and say, not so fast. And I think we rapidly got ourselves into one of these kind of not so fast situations again. And after this inflation data came out today, I think what you're going to hear from the next bout of Fed speakers is now we're up to 4 months in a row of higher than expected inflation. And we're hopeful that the May print looks better, and there are early indications that suggest that it will, because oil is lower. But the Fed comes out and say, well, if it's not, at some point they can't say, well, we're waiting. They have to say, look, we may have to do something about it. And so, but if you believe that the Fed will do something about it, then you should be cautious on risk. If you feel that the Fed is not going to do anything about it, then you could be bullish on risk. I think it is kind of binary and as simple as that. And I think we need to trade the ranges on that view. When volatility gets super compressed, like it is right now, into an expiry, I think the odds are that they're going to talk more hawkishly. When volatility gets more elevated, like into the Fed meeting, like it was, then they talk more dovishly. I think if we could use that framework, I think it'll be beneficial to us. I don't think that something materially changed that would lead us to kind of these new breakouts to 5,500 or higher imminently. I think there's another iteration here where the Fed needs to push back against the market, and I suspect that's what we're going to see in the coming weeks.
When is the next kind of combination of meetings and NFP and CPI? What are the key dates?
Yeah, I mean, it's kind of a bizarre calendar. I mean,
and then summer trading. Oh joy.
Yeah, look, we have a lot of Fed speak this week and into next week. And then next weekend is kind of Memorial Day weekend. But we have PCE is on the 31st, Friday, which is the last day of the month. And then the first week, and that's a Friday. And then the June June data comes in the first week of June. But the Fed meeting is on the same day as the CPI release. So the CPI release is in the morning. The Fed meeting is in the afternoon. In theory, the SEP projections are supposed to be in on the Friday before the meeting. I don't know if there's been an example in the past where the CPI actually fell on the day of the meeting. So I don't know what they're going to do as far as will they let people adjust there? I mean, I don't know how, I really don't know the dynamics of that's in play, but that will be we'll have CPI and the Fed on the same day, which is the Wednesday, the 12th of June. And I think what we're going to get out of that meeting is a reduction in the number of cuts expected for 2024 to 1, and several members at 0. And it's possible we may have one member looking for a hike. So I think we're going to have but the median dot will be 1. And I think the median dot for, next year will be, we'll probably stay at that, 4 cuts expected for next year. I think there'll be some dots that move the neutral rate up because there's been more talk about that as well. So again, it's how the Fed kind of intonates higher for longer. This is how they do it. They use the dot plot. Is the market going to care? I mean, we'll see. I mean, I think there's a bias that on soft data, the Fed will cut, and I think what we're going to learn at the June meeting is that they're not going to cut. So that's a that could be some fireworks that could end this kind of euphoria around the idea that the Fed liquidity is coming soon, and that we should just own every asset that's an inflation hedge, because the Fed actually does care about it. And then look, they speak out of both sides of their mouth. I get it. I watch it. I listen to it. Powell, does it all the time. He talks about financial conditions being tight. Talks about monetary policy being restrictive. It's like my lying eyes can see your lying eyes can see the other way. I mean, but I think he doesn't want to risk too much market disturbance. But when vol is so compressed like it is, I think it usually benefits you to take the other side. And as we pass through the May expiry later this week, I think the odds are, from more hawkish speak and a more risk off trading environment.
All right. One thing that seems a bit I don't know what you want to call it, obtuse, is something that I grabbed from Market Watch, and I want to show it to you and get your thoughts on this. So humor me for just a minute before we close, because I think it actually might be interesting. So I've already kind of talked about this, lower yield regime as part of my warm summer housing market theme, and it would be also kind of stability for the economy if we can get some units moving, et cetera, et cetera. But then I grabbed this Morgan Stanley residual seasonality, notion that seasonal adjustments from the U.S. government aren't being done properly in a way that moves first quarter numbers higher and rest of the year numbers down. So it's not a new thing, but it was a big thing right now, according to Morgan. Anyway, this is the impact. The technique comparing the average annualized numbers for a quarter to the 4-quarter average. So this is all statistical mumbo jumbo, but basically this is a call that they have that it seemed important. So I wanted to ask your opinion about this. Okay, so for the proceeding, and I've got my camera wires right in front of the words, so I can't read it so well. 2 years, I'm reading right here. Core PCE prices, you were just mentioning the PCE, so it's what triggered my thinking about asking you. The inflation numbers that mean the most to the Fed have seen a giant 1.32% point boost to first quarter numbers that erodes the year. What's that word?
Erodes as the year goes on. Yeah.
Sorry. The residual seasonality has shown up elsewhere too in the employment cost index, which we're like, flies on flypaper here when we see that number comes out. And in the productivity numbers, which to me, I'm very, very fascinated anytime we get the productivity numbers, because it absolutely moves the bond market. So anyway, wage inflation, productivity, employment cost index. So when so many price metrics display residual seasonality and show a similar pattern of its strengthening, investors would be forgiven for gaining confidence that the pattern will continue in the coming year. So translation, this is my translation. I want to get yours. Regardless of whether the economy weakens, bond yields could still fall as inflation data disappoints and that higher for longer crowd and narrative get attacked. So any thoughts on residual seasonality or what I'm kind of showing here, which to me just kind of struck me as, okay, it's all about statistics, huh? It kind of, it looks like it's a little bit of math mirage.
Yeah. I mean, look, this is, part of the reason why the Fed got so dovish in, into the second half of last year is there was their confidence in these numbers and the seasonality of this, deflation or disinflation that was happening. I think that was part of it. And so, yeah, in the first half of the year, the numbers look higher, and then the second half of the year, the numbers come in lower. And so, is that going to be something that changes the Fed's calculus on how they're thinking about policy? I'm not really sure. I think that the difference that I see now is that towards the end of last year, and maybe even to start this year, you had this idea of real rate normalization cuts, which was that as inflation falls, the economy, we should be cutting rates in order to prevent, additional tightening of financial conditions. And there was kind of a view, kind of the Williams view about R-star that introduced these rate cuts because otherwise real rates would be too high. And so what we have now is I think that's been kind of thrown out the window. And so I don't really see as much of an environment where the Fed feels like this economy needs accommodation and that it should add accommodation, which is what rate cuts would be. Back then, they were more concerned about growth. If you remember the Beige Book that came out in November they were very concerned, and that kind of helped the pivot. And so they started talking more about this real rate normalization cut nonsense. They've not talked about this. And more people have come out and said this economy doesn't need accommodation. And so for me, what that means is that a Fed that's not looking to give the economy accommodation they are not going to be quickly giving the economy accommodation when it slows. They are going to wait. They are going to be late again. And I think that is a toxic environment. You have a growth slowdown, you have inflation that slows less rapidly, and you have a Fed that needs to kind of sit on its hands and wait because it's been burned too many times. It was burned. You could argue obviously it was burned by being too late to cut, too late to tighten. Then maybe last year, maybe it stayed on too long and kind of caused part of the 3Q into October sell-off and risk. So maybe they shouldn't have that. Now it's the other way. Like this Fed is going to want to sit and wait for as long as possible. And so even as the data starts to decelerate and get worse, they are going to sit and they're going to wait. And so the narrative is going to eventually shift to the Fed needs to raise rates because inflation is out of control, to why is the Fed not cutting rates? Growth is decelerating too rapidly. And so I don't think, I tweeted that out today just as eventually that narrative shift is coming. And that's the case of like, you're not going to get paid on the first rate cut because the first rate cut is going to do nothing. An economy that is operating as robustly as it has been from a long and variable legs of tightening is not going to instantaneously react to a 25 basis point cut either. There is going to be no impact from that. And so then the Fed will have to cut again, and then they'll have to cut again, and they'll have to cut, right? So, and that is an environment that what we've seen, that's why people say you don't buy the first rate cut, you buy the last rate cut, right? Because then it's actually the rate cuts are working. This market has front run so much of the easing that the first rate cut will do nothing. And so I think that narrative shift is coming. And eventually the market will be begging for the cuts and the Fed will be slow to deliver them. and then they'll beg more, and the Fed will give some, and then they'll have to beg, and they'll keep going lower, and they'll
Petulant children.
petulant children are in constant need of what I casually refer to as the POM. It's the perpetually accelerating liquidity machine.
Yes.
And
it is working, by the way. I mean,
yeah, look there. Yeah, it
I
works.
have to show you the one last chart, and then we'll let everyone, have a little relief here. This is, in fact, in the way, but this is that kind of Fed liquidity model, and it tracks beautifully with SPX. I mean, you can kind of see where we had a little shake and bake there with the first of the year in the Mag 7. You can see where we literally topped out on March 27th and pulled back. I mean, financial conditions are the market. That's just what this shows, and how we have been ratcheting higher since basically the Friday the 19th put in that double bottom, and that's it. We're off to all-time highs again. So until this rolls over, we get a macro trigger for that to roll over. This and everything that you have just talked about is why we are still moving higher. So, all right. So that is it for macro to micro power hour. We'll do this again in 2 weeks, which would be, or no, when's the Fed meeting date?
The Fed meeting is the Wednesday the 12th. That's basically like a month from today.
All right, so we'll figure that out. But we'll definitely be back on the 12th. How about we do that? Then we'll figure out if we do this again in 2 weeks. But thanks for joining us and sticking around and asking your questions. Again, Samantha LaDuc, founder of LaDuc Trading, and Craig Shapiro, macro advisor, edge manager. Thank you so much. You know where to find us on Twitter, and we have a new website coming out in 2 weeks. Can't wait. All right, cheers, everyone.
Thank you. Take care.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.